committee hearing to order. It is December 15th, 2021. Just a little fact for you all to know. It's my mother's 97th birthday today.
Oh.
Yes. Awesome. Isn't that? Yeah, it's pretty cool. So she lives in Fort Collins, Colorado. We're going to have a party for her. And she is a party animal still. So very exciting about that. Very happy to have our Commissioner Showalter from MMB with us, our state economist, Dr. Laura Kolumbakidis, and our state budget director, our new state budget director, welcome, Anna Ming. And with that, I would like to turn it over to Commissioner. Would you like to start, or Dr. Kolumbakidis?
Sure. Thank you, Madam Chair. I'll start off, and would it be appropriate then just for us to sort of roll through the presentation and hold questions to the end, or how do you want to manage questions?
I think it would be easier to roll through the presentation, go in depth as more than perhaps what you did at the press conference or to us in our briefing. And then we'll have questions afterwards. But if you guys can just hold into your questions, that'd be great.
Sounds great. Thank you, Madam Chair. Hello, members. My name is Jim Showalter. I'm Commissioner of Minnesota Management and Budget. Happy to be with you here today with Dr. Laura Kolumbakidis. She's our state economist who really needs no introduction. And Anna Ming, our new state budget director and assistant commissioner. This is her first forecast as budget director. So she's got a very good track record. Today's forecast will include up-to-date information on the state's budget, as well as new information on the economy from our consultants, our national consultants, IHS Market. There's national data and trends.
How new is that information as of?
It was prior to the November or the December forecast, so it doesn't include the December update, though Dr. Kolumbakidis certainly can comment on any updates.
Okay, perfect. Thank you.
It was certainly those trends inform our forecast of Minnesota's revenues and or in the economy and the revenues that come from it, and handle economic assumptions and those other issues in her presentation. For budget insiders, I just want to point out that you'll remember that federal funds were part of the end of session talks, and maybe wondering if, when we're talking about numbers, if that's included in these numbers. The answer is just simply no. Federal funds are different, and so here we're talking about the state's own revenues, and particularly the general fund balance. So that's kind of what we have, and as always, there's a lot of detailed information. Really encourage everyone to take a look at the 100 pages of detailed explanation, charts, tables that are available on MMB's website at mn.gov/MMB. So with that as an introduction, Madam Chair, we'll start the brief. What you have in front of you is the deck that we shared on forecast day. And let's flip to that first slide. Today's forecast resets the state's budget. We anticipate a surplus of $7.7 billion by the end of the biennium. And the good news continues throughout the planning horizon. As these key points and key summary points from this forecast suggest, now we're seeing a number of different pieces and news that we'll explore in this presentation. First is just that we closed out the previous fiscal year that ended on June 30th with strong tax collections based on growth in income taxes, on consumer spending, and on corporate profits. And this pushed more than $3 billion of increased revenue into the projected surplus. With our economy and our economic activity already well above expectations, it follows that even just modest changes in our economic projections create substantially more revenues than previously expected. And that additional revenue gets us to the substantial improvement that we're anticipating for the biennium of 22 and 23. As always, our forecast is based on current law. So we work through those estimates of what's the economy, what are the tax treatment and tax estimates, the spending estimates, but note that there are also triggers found in statute. So once we've estimated the sort of forecast change, in this case, some of those triggers have additional impacts. That one of the biggest is the one that replenishes the state's rainy day fund, our budget reserve. With this forecast, the budget reserve is again full at $2.656 billion. Obviously, I appreciate looking forward to the questions because forecasting is tough, and it's particularly tough when we're going through very turbulent times. But at this point, I should note that we do see the budget improvement not being a one-time phenomenon, but continuing into the future. Bottom line here, $7.7 billion is out of the ordinary, even in the extraordinary times. But fortunately, the state's position has been and continues to be strong. And we're going to continue to work with that and with you to make sure that we continue that. Because at the bottom line is this forecast really does underscore the state's ability to sustain services and respond to emerging needs. The next slide just starts to give you a pictorial version of what's going on. Following that, I'll just give you a quick numbers view of it. If you're a graphics kind of person, you just basically see there's a couple of different pieces. We started the projections for 22 and 23 with what would be left over from the last budget negotiations, which was $127 million. But even as we were all working on the end of session negotiations at the end of June, already published had been extremely strong monthly revenue collections due to the factors I mentioned before. That added a $2.8 billion of revenue improvement. In addition, appropriations, as you know, state agencies spend up to but not exceeding appropriations from the legislature. So at the end of a biennium, any appropriations that aren't spent are going to cancel. It's not going to be more than the appropriations. There are always going to be cancellations. And in this case, there were $300 million of unspent appropriations at the end of the biennium, getting that $3.1 billion boost from fiscal close. The forecast today also incorporates, what I said is pushing that and sort of estimating what's going to happen in the years ahead. And so on that blue bar, you look at sort of what's going forward and where we anticipate going. Combined with small reductions in spending, we project an additional $5.5 billion to the bottom line for the current biennium. But as I mentioned before, there are triggers that allocate some of that improvement to certain things. That includes the budget reserve, it includes the charitable gaming revenue that go into the stadium reserve, it includes the trigger on June accelerated sales tax, and it includes $4 million to the 21st Century Fund. Those are taken out and get to this bottom line of $7.7 billion. The next table just gives you the same story in numbers. And I think the part that I want to underscore here is that every forecast, you're projecting into the future. There's uncertainty and questions about it. But as you can tell with the beginning balance, that there's less speculation, and at least at this point, that we're improved from where we had before than usual, because there's so much money in the bank. We're starting the biennium with a significantly higher number than we've been anticipating previously. And so those revenues that in July were about 11.2% higher than previously expected, really start us in a much stronger position. As you go through this chart, you'll see that revenues are anticipated to total about $56 billion, or about $5.1 billion more than anticipated after last session. Changes in spending, usually there's more significant changes in human services, less in education and other items. Bottom line here is the net change of all of these items isn't particularly large, but there are a number of items that State Budget Director Mingy will talk about. The surplus gets a bit of a boost from lower spending, driven mostly by lower K-12 enrollment projections and some favorable financing of the state's pandemic work. But on the bottom line, it's about $364 million. I mentioned before about the state budget reserve, the cash flow account remains there in the stadium reserve, which I mentioned before. So, that's kind of the overview of this forecast. I'm going to turn it over to our state economist to walk you through now the economic factors and the revenue projections that really undergird our revenue forecast. Dr. Kolombakidis.
Thank you, Commissioner. And thank you, Dr. Kolombakidis, for being here, and go ahead.
Thank you, Madam Chair, members of the committee, and thanks Commissioner Showalter. So for the record, I'm Laura Kolombakidis, Minnesota State Economist. I'm going to start with the U.S. outlook and how it changed between February and November. I'll move to Minnesota's economy and then I'll turn to details of our new revenue forecast. So the first chart I'm showing you is levels or dollar values of real GDP. We're showing both the history and IHS's November forecast for 21 through 25. So if you look towards the left-hand side of that chart, you can see the decline in GDP that occurred during the recession of 08-09, and then the 10 years of steady economic expansion that followed. Then, starting in the spring of last year, you can see the abrupt two-quarter contraction that was triggered by the COVID-19 pandemic. So that was 2 quarters. I think it's the first and the second quarter. So really just a very deep plunge or contraction there in 2020. But then you can also see the sharp bounce back in the second half of 2020. And then the steady growth that is expected to follow. So that was it was a large contraction, and then it was a large quarterly growth rate as well. Unexpectedly strong economic growth last year and this year have driven tax revenue gains at the federal level and in many states, including, as you heard from the commissioner, here in Minnesota. As the US economy continues to recover from the 2020 recession, personal income, home values, financial asset values, corporate profits, those have all risen. The US unemployment rate fell in October to a seasonally adjusted 4.6%. I think as of November, it's at 4.2%. That was the lowest since March of 20, and total employment is at 97% of what it was before the pandemic. IHS expects employment to recover to its full pre-pandemic level in the middle of next year. Some important economic variables exhibited stronger growth than expected so far this year. The current IHS forecasts for employment and for real or inflation adjusted consumer spending are higher than their February outlook. In addition, forecasts for some nominal variables or variables that are influenced by inflation, including nominal consumer spending, wage and salary income, and corporate profits. These are variables that more closely influence tax revenues. These are also higher than in February. IHS in their November outlook is forecasting US real GDP to increase by a robust 5.5% this year, and then decelerate to 4.3% in 22. Growth next year, so in 22, is expected to be supported by a declining rate of COVID-19 infections, easing of supply chain blockages, and increased labor force participation, although they're expecting that labor force participation growth to occur over a couple of years. Real GDP growth is then expected to average 2.7% in 23 through 25. In their December outlook, IHS has raised their forecast for real GDP growth in this year to 5.7%. Next year is still at 4.3%. And then it goes to 2.6 in 2023. So the US outlook remains uncertain, of course, and you heard that from the commissioner as well about forecasting remaining uncertain. And it depends on the path of the pandemic and on the responses of households, businesses, and governments to the changing public health landscape. In this forecast, in the November forecast, IHS assumes that the rate of COVID-19 infections continues to recede. And the statement they made in that outlook was that they now expect US society to move toward managing the risks of coexisting with the virus for an extended period. Their outlook was produced before emergence of the Omicron variant became known. The November IHS outlook reflects the Infrastructure Investment and Jobs Act, signed into law November 15th. They did not include the Build Back Better reconciliation bill because the scope, the timing, and the size all remained too uncertain. And in their December outlook, they still have not included impacts from the Build Back Better bill. I'll now walk through a few examples of changes to US variables that influence or impact Minnesota's tax revenue forecast. So this chart shows levels of US spending on durable goods. This is not a real variable, this is nominal, so it includes price increases. And so these are durable goods other than automobiles and medical devices. And most of these things, the kinds of things that people buy under durable goods, would include furniture, appliances, athletic equipment, electronics, those are things that are taxable under Minnesota's sales tax. The solid line shows IHS's November outlook, and the dashed line shows what they expected in February of this year. So as you've heard before, and as I'm sure you all know, during the pandemic, consumers shifted their spending away from personal services and recreation, so things, the face-to-face sorts of services, travel, substantially exceed its pre-pandemic peak. And it remains at elevated levels. It's come down, as you can see in the chart, but it remains higher than it had been expected. Spending on durable goods is expected to grow 23% this year, more than double the rate that was forecast in February. The next chart illustrates the changes in the inflation forecast. So following years, so all of the time actually that I've been state economist, price levels have not been that big a story because inflation has remained low. But following all those years of low inflation, price levels have become more salient in this forecast. In this chart, the height of the bars shows annual growth in the consumer price index. So the blue bars show the history and IHS's November outlook, and the gray bars show their February for this year to 4.5%, from 2.1% in their February outlook. For next year, they expect, in the November outlook, they expected 3.3% inflation compared to 2.1% in February. So those changes for this year and next year, so those increases in the inflation expectations, those are due to two main developments since February. First, increased energy prices, including oil prices. Those have been substantially higher than expected in February, and they're expected to remain elevated in the near term. Second, that high demand for durable goods, along with global issues with the global supply chain, those have caused a surge in durable goods prices. Regarding their new outlook, IHS is now forecasting as of their December outlook, they're forecasting 4.6% CPI inflation in this year and 3.7% next year. So they've raised the outlook a little bit this year and next year. They do still, so as of their November outlook, they expected CPI inflation to settle back down to close to 2% by the end of next year. In their December outlook, they still expect it to settle to 2.3% in 2023. So it's a little higher, but it still gets down into the twos going forward. IHS expects the gradual resolution of supply chain issues and rising U.S. labor force participation to slow inflation. They forecast, I just said that they expect CPI inflation to settle near 2% annually. So related to the inflation forecast, as of their November outlook, IHS expected the Federal Reserve to begin taking action to raise the federal funds rate in March of 23. In their December outlook, because of the higher forecast for inflation, they've moved this assumption to September of next year. So they've made it sooner. Let's see. So let's move on to the next chart, which is wage and salary income. This is growth in U.S. wage and salary income. We use this forecast as part of it's one of the inputs we use to forecast Minnesota wage and salary income. It's not the only thing. We use Minnesota specific variables as well, but this is an influential variable. In this chart, the height of the bars shows annual growth in U.S. total wage and salary income. Note, so I mentioned this on forecast day, but if you look at last year for 2020, you can see that wage and salary income grew 1.3% in 2020. Now, this is not average wages. This is total wage and salary income. So the payrolls, the sum of all the payrolls of all the employers in the United States and the growth rate in that. So the U.S. saw growth in wage and salary income, even as unemployment peaked last spring at nearly 15%. For the US. So this illustrates for wage and salary income to grow like that at a time when so many people have lost jobs, illustrates the unevenness of last year's employment and income losses. As you know, low-wage workers were much more likely to lose jobs than high-wage workers as the pandemic took hold. The last 2 years have seen a decline in the U.S. labor force participation rate as workers have opted out of employment for a variety of reasons, including difficulties finding affordable and accessible childcare, lingering COVID-related safety concerns, early retirement, and trading employment for starting a business. In October of this year, the U.S. labor force participation rate was 61.6%, well below the 63.4% prior to the onset of the pandemic. IHS expects the tightening labor market, where a tight labor market means high demand for workers and low unemployment. That tight labor market is expected to drive up wage and salary income, and they, as of their November outlook, expected strong wage income growth of 8% this year, up from 6.7% in their February outlook, followed by only a small deceleration to 7.9% next year. And then the forecast has been revised upward significantly for years 22 and 25. Those numbers, that forecast for wage and salary income as of their December outlook is a little higher for this year. It's at 9.1 and 8.5 next year, and then lower beyond there. So they've pushed some of that wage and salary income growth into more recent years from years that are further out. Next chart shows levels of US corporate profits. Now, this is the main variable or the main factor determining corporate tax revenues for the state of Minnesota. So our corporate tax revenues. The solid line shows IHS's November outlook, and the dashed line shows what they expected in February. Corporate profits were unexpectedly strong during the first half of 2021, first half of this year, and that drove higher than expected corporate tax receipts this year, and that was at the federal level and in states. And it also drove an increase in the corporate profits forecast. So in this outlook, corporate profits are expected to grow 19% this year. That's nearly 4 times the rate forecast in February. Moving on to talking about the labor market and comparing Minnesota to the US. This chart shows unemployment headline, the headline or overall unemployment rate. The dark line shows Minnesota, and the light line shows the dark line shows Minnesota, and the light line shows the US. The vertical gray bars show the US recessions. You can see the very skinny gray bar in 2020 for that short 2-month recession, COVID-triggered recession. And then during that, in coincident with that skinny gray line, you can see the sharp spikes in unemployment last year when Minnesota's unemployment rate reached 11.3%. As of October of this year, the state's unemployment rate fell to 3.5%. In November, I think it's down to 3.3%. But that 3.5% was 1.1 percentage points below the US unemployment rate, and at the time, the 14th lowest among US states. Overall, that overall unemployment rate doesn't capture important distinctions between groups. It also doesn't capture Minnesotans who have left the labor force, including retirements, those staying home to care for children, those who have traded jobs for entrepreneurship. Since the onset of the pandemic, Minnesota's labor force has fallen by 84,000. As of October, our labor force participation rate was 67.8%, 2.4 percentage points lower than in February of 20 at the onset of the pandemic. Nevertheless, the state's participation rate, while it has fallen relative to where it was before the pandemic, it remains high relative to the US. So as of October, 6.2 percentage points above the US rate, and the 5th highest among US states. And as with that US forecast for wage and salary income, we expect a tightening labor market in Minnesota, high demand for workers, low unemployment, to drive up total wage and salary income in the state. Remember that total wage and salary income variable can grow if more people are working and if the people who are working have higher average wages, or if both of those things happen at the same time. The next chart gives you the image of employment. This isn't a forecast, these are actuals. Employment in Minnesota through the pandemic period. So going back to the left from 2009, so we started at the end of the last recession, you can see the really quite steady employment growth Minnesota had during those 10 years of economic expansion. You can also see, if you look closely, get close to the peak of February of 20, it looks like the slope of that line is starting to become more shallow. And that's because our employment growth rate was slowing even before the pandemic hit. And that was largely due to slowing of labor force growth in Minnesota due to aging of the population. So in April of last year, just as the pandemic was taking hold, of course, Minnesota abruptly lost 416,000 jobs. So there's that big plummet, approximately 14% of February 2020 employment. Since then, Minnesota employers have added jobs in nearly every month. Through October of this year, 296,000 of the jobs originally lost have been recovered. Our employment is now 121,000, or 4% lower than in February of 20. So my next chart or table is going to be about the revenue forecast. The first two columns of the table show that prior biennium picture that the commissioner talked about. Those first two columns show actual receipts at the close of fiscal years 20 and 21 and the change from the prior estimate. And then the next two columns show the current forecast and the forecast change for the current biennium for 22 and 23. Now, I mentioned that income, consumer spending, and corporate profits all grew more in calendar year 21 than had been expected. Calendar year 20 and 21 more than had been expected. This drove extraordinary revenue growth in fiscal year 21, which ended with revenues $2.775 billion ahead of our February forecast. That's the bulk of that $3.1 billion carryover from last biennium to the current biennium that Commissioner Showalter described in his overview slides. Moving to the second two columns, higher tax receipts to date in fiscal year 22, so to date as of the time we did the forecast, and an improved outlook for income, consumer spending, and profits raised the revenue forecast for 22 and 23. Total general fund revenues for the current biennium are now forecast to be $5.130 billion more than the February forecast. So we've raised the forecast for all the major tax types. Individual income tax receipts are now forecast to be $2.7 billion more than the prior forecast. So we have a higher estimate for tax liability in 20, tax year 20. So that's a year that had higher growth than expected. And remember, we had higher than expected income tax receipts in fiscal year 21. That implies that our estimate of tax liability for fiscal year 20 was too low. So we now have a higher forecast for tax liability in calendar, maybe I said fiscal year, but in calendar year or tax year 20. And that's the base year for our income tax forecast. So we have a higher base, and we now have higher growth, expected growth in wage income, as I've mentioned, and in non-wage income, particularly business income and capital gains realizations. And those things together raise the income tax forecast for the remainder of fiscal year 22, and then for fiscal year 23. Sales tax revenue is now forecast to be $821 million more than the prior forecast. That higher forecast is consistent with the increased growth in consumer spending I mentioned earlier. So it's both growth in real spending and growth in increased price levels. And it's also due to higher collections so far this fiscal year. The forecast is reduced by $359 million for eliminating the June general sales tax acceleration. The corporate tax is projected to generate $1.249 billion more than the prior estimate, based on the higher forecast for corporate profits and higher collections so far this fiscal year. The next slide, I'd like to reiterate some of the risks that I've mentioned or hinted at least so far. I mentioned that the forecast depends on the path of the pandemic, including any new coronavirus variants and treatments that may arise. The assumption embedded in this forecast that inflation settles back to the 2% range at the end of next year depends on the resolution of supply chain blockages and on an increase in labor force participation at the US level. And higher or more persistent inflation can change the timing and expected actions by the Federal Reserve. We know now that in the December outlook, IHS has raised their expectation of inflation this year and next. They still expect a settling down into the 2% range, and they have accelerated their expectation of when the Fed is going to start raising the federal funds rate. Supply chain disruptions and the pandemic path both threaten growth in other countries. Slower than forecast economic growth in any of our major trading partners can reduce demand for US produced goods and slow growth in the US. And then finally, with 19 months remaining until the end of this biennium, even small changes in assumed growth rates in particularly important revenue sources can have big changes in the outlook for this biennium and the next. I'll now turn it over to State Budget Director Anna Mingi.
Thank you, Dr. Kolombakidis.
Excuse me, Director Ming, before we start, I just want to clarify something either with the Commissioner or the State Economist on the 1.2 billion from the SRF. Is that included as federal revenue in the general fund or not?
Commissioner, you want to take that?
Sure, Madam Chair. The 1.15, I think, billion dollars that remains in the ARPA allocation is not included in this. So that would be, those are still resources above and beyond what we're talking about here in the general fund. There is certainly revenue replacement and other elements that brought resources into the general fund that were part of the end of session negotiations. Those were in our end of session numbers and continue to be. But that additional about $1.2 billion is on top of what we're talking about here.
Okay, well, that's different than what I was led to believe. So, okay, good to clarify that. Thank you. Okay, Director Ming, thank you.
Thank you, Madam Chair. I'm Anna Mingi, State Budget Director with MMB, and I'm going to walk us through the changes on the expenditure side of the forecast. This slide outlines changes in general fund spending in the recently closed biennium, as well as projected changes in the current biennium. So as you've heard from the Commissioner and State Economist, the changes in fiscal year 2021 are meaningful because they're part of that significant balance that carried forward into the current biennium, which is contributing to the projected surplus. So overall, spending changes are relatively small, about 0.7% lower in both the previous biennium and the current. But let's start by discussing those changes in 2021, which are represented by the first two columns of numbers on the table. So E12 education spending is the largest portion of the general fund budget, but it was $84 million lower than end of session estimates. This was a result of fewer than expected pupils. Health and Human Services spending was $102 million below previous estimates, largely the result of underspending in non-forecast areas of the budget, such as agency operations and some capped grant appropriations. The next line, property tax aids and credits, was $80 million lower than previous estimates. And much of this is a result of reallocating general fund spending on business relief grants from the general fund to federal coronavirus relief funds. So I want to discuss that topic a little more. Minnesota, as you all know, committed significant general fund resources to respond to COVID-19 early in the pandemic. And while we made those investments quickly, we did so with a mindful eye to fiscal responsibility. So as funding has become available through the federal government, MMB has looked for opportunities to reallocate previous expenditures to those federal resources, which provides relief to the general fund. The changes on this line are just one example of that work. And because they were administered through the Department of Revenue, they're showing up on that property tax aids and credits line, the business relief grants. Then all other areas of the state budget had combined lower spending of $65 million. And much of this is underspending in areas of the budget that carried forward into fiscal year 2022. Next, moving on to the current biennium, we can go back to thank you. Total spending is forecast to be $364 million, or about 0.7% lower than end of session estimates. As you can see on the table, the largest change is in E12 education, where we see a reduction of $326 million from previous estimates. The state education forecast has been updated to account for declining growth in our student population. We have new and improved data that has resulted in some updated numbers which drive general fund savings. The largest driver of this reduction is just the incorporation of 2020 enrollment trends. Pupils grew by less from 2019 into 2020, which lowers the projected rate of growth going into future years. The next line, Health and Human Services, spending is $94 million lower than end of session estimates. A large driver of this change is lower enrollment in the state's child care assistance program during the COVID-19 pandemic. State spending on property tax aids and credits is also projected to be lower. This is a result of lower projected spending for renters' property tax refunds. Debt service payments are also below previous projections due to lower bond rates in our September 2021 sale and updated cash flow estimates on existing bonding projects. All other areas of the state budget are $136 million above previous estimates. This is primarily due to appropriations that were carried forward from fiscal year 2021 and are now projected to be spent in fiscal year 2022. This spending increase in the all other line also reflects a $30 million contingent appropriation to the disaster contingency account at the Department of Public Safety. This appropriation was triggered by a positive variance in the general fund in closing balance for fiscal year 2021. So we can move on to my next slide to look at changes in the general fund budget reserve. This chart illustrates the growth in our general fund budget reserve in recent years and highlights the changes we see in this forecast. So the dark blue bars represent the forecast budget reserve balance as of the end of session, and the light blue represent additions made in this forecast. This forecast allocates an additional funds to the general fund budget reserve, reaching our statutory target established under Minnesota's nation-leading budget reserve policy. Since 2014, Minnesota has had a budget reserve target that's based on an analysis of revenue volatility. And our state law directs that 33% of the November forecast balance goes to the reserve until that target is met. Our current target, which was updated this fall, is 4.8% of general fund revenues for the current biennium. So as you can see on this chart, in the last forecast, we projected a decline in the general fund budget reserve from 2021 into 2022. This was the result of two provisions enacted by the 2019 legislature, which resulted in $591 million moving from the reserve into the general fund. However, last session, the legislature directed that the first dollar of any future forecast surplus would go to the budget reserve until it returned to $2.377 billion. So with this November forecast, not only are we restoring the reserve to the $2.377 billion, there's an additional deposit of $279 million, the amount necessary to reach our new budget reserve target. So in total, this forecast results in an $870 million increase in the general fund budget reserve. And with those increases, we achieve the target set in law. And with that, I'll turn it back to Commissioner Showalter.
Thank you, Director Ming. Okay, Commissioner Showalter.
Thank you, Madam Chair. Let me just then close out a couple of more quick slides. As you know, Minnesota's got a tradition of taking the long view towards its budget and finance. And, this committee has been an important protector of that long-term view to make sure that we have sort of balanced budgets, not only in the current year or current biennium, but so that we have revenues and expenditures that match over the longer term. What this slide shows you is our projections for the 24 and 25 biennium, taking revenues anticipated over that period, which grow at around 3.7%, and projected spending. And that's basically current law appropriations for the biennium with adjustments as in law for the different types of healthcare programs and enrollment and education and a few other adjustments, but that grows by less than that 3.7%. What is not included in the projected spending numbers, as you also probably all know, is the projected impact of inflation. We don't include that in the forecast, and that's expressly prohibited from being part of the forecast. If you were to include it, it would be about $1.16 billion. But either way, this is good news because we see that the projected revenues match or exceed the projected spending, no matter how you count it. Obviously, inflation is going to be one of those issues that we'll talk about, I'm sure, throughout session, because inflation is present in the current biennium, and there isn't that impact of inflation put into the spending numbers. We basically are locking in the appropriations from end of session. But inflation will cut into that purchasing power in the current biennium, and obviously, in longer term, revenues do include the impact of inflation, so that if things cost more, the amount that's taxed, if it's a percentage basis, will grow. So revenues can grow with inflation. But to wrap up, Madam Chair, it's been a tumultuous couple of years, and we just have an immense amount of gratitude for everyone who's contributed to sustaining the state's economy, to sustaining state services, for the healthcare workers who keep plugging away and trying to take care of Minnesotans. And we're happy to bring to you some really strong news, and happy to take questions as the committee has for the forecast.
Thank you very much, Commissioner, and to all three of you for this summary. We do have a question. I do want to just clarify something before we break it open to all other questions on the revenue replacement, Commissioner, which is the 1.2 billion. State Director Ming mentioned the reallocating the business relief grants through revenue replacement, the general fund replacement piece that we did. That total amount is 1.2, is that correct? And is that accounted for in this forecast?
Madam Chair, great question. Thanks for coming back to it, because we have two different $1.2 billion figures, and I think that's where the confusion lies.
Right.
Yes, the revenue replacement, I think there's a couple of items like around $630 and $550 million that are in the forecast. So those are in the end of session estimates, and those are in this forecast. What isn't, what I was referring to at the top of the presentation, is that there are remaining $1.15 billion of ARP funds that were unappropriated at the end of session. And so those are outside of the balance that we're talking about here for the general fund.
Great. And I know we'll have some questions on the ARPA money, the 1.15 that's available, but will we be able to get a summary at some point? I don't want to add to your load, but at some point we should have a list of all the revenue replacement items that we did go through last year.
Yeah, Madam Chair, members, we'd be happy to walk through that. I think there's a lot of interesting work that's going on there. I just got to shout out to my team at MMB for their efforts to continually try to refinance and bring state savings into the state. We've been really successful in doing that and meeting the expectations of the legislature and exceeding them in this forecast. I think total we're at about $310 million of state savings. The Departments of Health, Human Services, Revenue, many others, DPS, have all been instrumental in making this happen as well.
Oh, and I totally agree. Thank you very much, Commissioner, to all that you work with. Really appreciate it. I have a few more questions, but I am going to turn it over to Senator Kiffmeyer.
Thank you, Madam Chair. Question I have, I'd like to know a little bit more. I noticed a drop in the assumptions on inflation. So I'd like to know a little bit more about what were the reasons for dropping that prospective inflation number. I think it was 24, 25, 23, somewhere in there it dropped. And if you could just explain a little bit more why you assumed that inflation would drop then.
Dr. Kolombakidis?
Yes, Madam Chair, Senator Kiffmeyer. So IHS is assuming that the inflation, so a lot of the inflation, the reason for their inflation forecast for this year is because of price levels that have already changed. And then for next year, they're anticipating that inflation still, prices remain elevated. But they are expecting two things to happen that will slow inflation into, by the end of next year, into 23 and beyond. And those are, they are expecting resolution of these supply chain disruptions that we hear so much about. The inability to, get ships docked and unloaded and all of those kinds of things. They're anticipating that's going to loosen up over the next year. And then over the next 2 or 3 years, they're anticipating a gradual increase in the labor force participation rate at the US level. So it's not a dramatic change. It's a gradual increase in labor force participation. So they're expecting more people who potentially left the labor market during the pandemic to come back in, and that increased labor supply will loosen the labor market a little bit and slow price changes.
Senator Hickmeyer.
Yeah, thank you, Madam Chair. That's only from an HHS perspective. I know that's a big driver of the whole process, but I was looking for kind of a little bit broader inflationary impact, not just from HHS. So you might add something to that. And I think also 4% fewer jobs also affects revenue and then increases expenses, often because of the use of other services. Those two kind of pair up together. So 4% fewer jobs. Is there any analysis as to how those jobs are going to return, how they're going to be created? Why have they gone away? How are we going to get them back? Just address that area. Thank you.
Dr. Kolumbakidis.
Yeah, Madam Chair, Senator, Minnesota's total employment remains below its pre-pandemic peak, that 4% that you're talking about. The disproportionate number of those job losses were in the face-to-face service sectors, those industries in leisure and hospitality in particular. And those are the sectors that are still struggling to get back to that pre-pandemic peak. So how do we expect that to change? There are a couple of things going on. One is that in those sectors that are affected by COVID, there's still some changes that need to happen. Consumers need to feel safer engaging in those, purchasing those services and engaging in those activities. But one of the things that is slowing employment growth is slower labor force growth and the decline in labor force participation rate in Minnesota. So we do expect, as IHS expects for the US, we do expect some gradual increase in the labor force participation rate. We don't expect it to get back above where it was before the pandemic, because prior to the pandemic, we had structural change in labor force growth having to do with aging of the population. So what happens next in terms of employment growth, we expect continued demand for those services to increase demand for labor, and that increased wages in those areas, those industries, to bring some people back into employment.
Thank you, Madam Chair. I'm sure we'll have many more pieces of information coming forward, but thank you.
Absolutely, thank you. Senator Johnson.
Thank you, Madam Chair. And this is a question for Dr. Kolumbakidis. On your risk chart, one of the things that I was curious about, I didn't see on there actually, was on the revenue side, when we're talking about individual income tax and sales and use tax. I think we've all benefited from the federal programs that have come through, but just wondering what the risk is to our tax revenue and our individual income, individual tax revenue as well, to the state, if we no longer see the federal tax revenue hitting our those areas on that revenue side. Just wondering if you could talk about that a little bit.
Dr. Kolumbakidis.
Madam Chair, members of the committee, that's a great question, because we know that some of the growth, unexpected growth we saw in calendar year 20 and the first half of 21 was supported by those federal payments. And so it's a good question to be concerned about what happens as those payments dissipate. And what I would say is that there, of course, that's a risk, is not fully knowing exactly what happens to consumer spending as the payments dissipate, but estimates of that are embedded in our forecast. So the U.S. forecasters and we are aware that those payments, for instance, the pandemic unemployment relief benefits, the stimulus payments, that those things are no longer being paid. And so we have adjusted our expectations for that occurring. I will say, though, that there is risk to how much of business income and corporate profits were boosted by the federal payments, and some of the unexplained growth in corporate profits and business income that we've seen we've looked at that and tried to estimate how much of that is because of federal payments and how much of that doesn't carry forward. So in our estimates of business income under the income tax and corporate profits under the profits tax, we have tried to estimate what happens going forward and how much of this continues. It's a good question, and it does create some risk in the forecast.
Senator Johnson?
That's all. Thank you very much.
Thank you, Senator Johnson. To that, Dr. Columbakidis, you've mentioned the high demand on the durable goods. Has anybody been to Target lately? There is nothing on the shelves. There's a run on toilet paper, I'm just going to say right now. But I am very concerned about the ag market, which is a great indicator of what is happening. There is a tremendous amount of wealth and money that is being held by our farmers, but they can't buy anything. They can't buy any tractors. So do they pay their taxes early? Do they wait till equipment comes in and off they go, and they trade in for some new equipment? I mean, this whole supply chain is very flexible and fungible, and I think it's going to have a lot more emphasis than we realize. But maybe I'm wrong. So Dr. Columbakidis, can you respond to something about that?
Sure. Madam Chair, members of the committee, it's almost as if, Senator Rosen, you've been sitting in on some of my conversations with my staff when we're talking about the ag sector and what will farmers do. There's a demand for those durable goods, for the, as you said, equipment and tractors. Can they get them? And you're right. We also are thinking through, okay, so does that change the cash flow pattern for when they're making their payments? All I can say is that we're thinking about those things too, and trying to estimate them as best we can. And I emphasize in my notes and in the book that the macro forecasters are making assumptions that the global supply chain issues do get resolved. And so when they make assumptions like that, that creates some risk for us when we accept their forecast. I would say, though, that it does seem reasonable that while it'll take some time, that high prices for durable goods and for fertilizer and such, in the case of farmers, those high prices should draw in producers who are eager to make profits off of those out of those high prices, and that should increase supply and eventually drive some of those prices down. So it does seem like the global supply chain issues are the kind of thing that markets can make a dent in.
Okay. And a year ago, I know we were talking about the highest ever in savings, personal savings. Yeah. I think it's back down. I was reading last night. I think it's back down to normal, I believe. And so there is a lot of money that people want to spend. It's just, is there anything to spend it on? that's the question too. Anybody else have any questions? I do have a question about the ARP money and the regulations, and maybe Commissioner, you can, or the guidelines on spending on that. Are there any specific guidelines? Can that be used for the UI fund? Can it be used for, not that we need revenue replacement, but anything else? Any specific guidelines, Commissioner?
Madam Chair, members, yes, there are guidelines. They came out, trying to think, it was like late May was the first ones, and then I think all scrambled to try and understand what they meant. During the month of June, I think it's become a little bit more normalized now. Certainly all of the ARP funds have to respond to problems associated with COVID. But, like the examples you mentioned, the UI fund, yes, I think that would be an eligible expenditure. Obviously, a number of different types of investments. The more specific we get it, the easier it would be for our team to assess and talk with other states to see if it's an acceptable or has been approved by the feds at some point in time.
And Commissioner Showalter or Senator Pratt, what is the amount that we need to at least make that fund? Does anybody know? Senator Pratt, do you know?
Madam Chair, last time I talked to Deed, it was right around 1.1 billion that we owed the federal government. I was tracking the interest on that debt. We're racking up roughly between December 3rd and December 13th. We racked up about $700 million or $700,000 in interest. So we're accruing about $70,000 worth of interest a day on that debt. It's a big number. And so we will see some impact to UI premiums. The base rates are going to go up. There are additional assessments for not being fully reserved. There's additional assessments for the debt that we owe. We have to pay the interest, and there's a separate assessment for that. And Minnesota employers will likely lose some federal tax credits through FUTA that are coming out. But I have a meeting with Commissioner Grove next week to discuss some of those.
Okay. What happens, Senator Pratt, I hate to put you on the spot, but what happens if we do not pay that back to the federal government?
Madam Chair, we'll pay it back somehow, some way. The feds are going to get their money. That's what the additional assessments are for on the UI tax rates, which is going to make payroll taxes increase significantly. Madam Chair, if I could just ask a quick question.
Absolutely.
And it's maybe outside of Commissioner Showalter's jurisdiction, but I know we index our tax rates to the chained CPI. And I guess my question, commissioners, how much of this additional tax receipts are coming through based on elevated wages? And it seems like what we're seeing is the adjustment is about 3.5% on the tax bracket, but we're seeing wages increase. I think some wages and chain CPI closer to about 5%. Have you discussed that delta, and are we seeing higher wages and due to inflation drive that excess tax receipt?
Commissioner Showalter?
Madam Chair, Senator, great question. I'm going to call in Dr. Kolumbakidis for some help on this one, because it is a conversation we've had about how much of this revenue change is really due to inflation and in the different ways that it shows up.
Thank you. Dr. Kolumbakidis.
Sure, Madam Chair, Senator. So the way that the indexing, we index the brackets by chain CPI, you're correct about that. And what that's meant to do is to maintain the marginal tax rate of the taxpayer, so that inflation isn't pushing people into a higher marginal tax rate. But you're right that the wage income itself is affected by inflation and can rise because of inflation. And that will, even if you stay within the same tax bracket or your marginal tax rate stays the same, that can increase the amount of revenue that we take in. So the indexation doesn't prevent us from getting more tax revenue due to inflation. It prevents people from being pushed into a higher marginal rate due to inflation. How much of it is due to inflation? How much of the increased forecast in the income tax is due to inflation? I don't have an answer to that.
Senator Pratt.
Thank you. Well, I was just kind of curious because I saw a press release come out yesterday from the Department of Revenue. They'll be adjusting the brackets by 3.1%. Just a quick search on the internet showed that chain CPI through August was up around 5.3%. So I'm concerned that our brackets, the change in our brackets aren't keeping up with what we're seeing in the economy.
Dr. Kolombakidis.
Madam Chair, Senator, there's a timing issue in this regarding at what point, which inflation measure we use, like which year-over-year change we use applying to the brackets. And I can't get at the details of that at the moment, but we'll get back to you on that question.
Thank you.
That's an interesting question that I need to know the answer to as well. Thanks.
Thank you.
Senator Pratt, I love it when you stump the state economist.
Extra points.
Yeah, there you go. Senator Kiffmeyer.
Thank you very much, Madam Chair. So the question I have to do is recently the Infrastructure Act was passed, putting a lot of money into our states all across the country. So serving on transportation, that's always a good news thing. But the big thing is, how does that factor into this forecast? How are those funds recognized within this forecast and what impact they might have? And then the other thing is there are other economic impacts as well. So in other words, the money comes and so there may be increased tax revenue because of that, jobs increased or other kinds of goods and services expensed. So just all of that, if you could just address that for a few minutes. Thank you.
Dr. Kolombakidis or Commissioner Showalter? Dr. Kolombakidis.
Sure, Madam Chair, Senator Kiffmeyer, in our forecast, we have the way the Infrastructure Investment and Jobs Act spending affects the forecast is through the U.S. outlook. And so in the U.S. outlook, the IHS has a fairly small increase in real GDP growth coming in, gosh, I'm not sure what year, but it's not immediately. It comes in a few years. And so they have an effect on real GDP growth. And then if they have an effect on demand for durable goods and on demand for workers, infrastructure workers, I haven't investigated in that level of detail. So what I do know is that it affects the government spending part of the forecast, and it affects U.S. real GDP in a couple of years.
Senator Kiffmeyer.
Okay, thank you, Madam Chair. I still am. So the funds that come into transportation, broadband, and other things like that are able to be expended. And I think the other question is, how does that fit in with our budgeting? I think usually the feds have you can't supplant it. You have to be adding to it. And I don't know if it's a maintenance effort or just strictly above the budget line. Is that the case this time as well?
Dr. Kolombakidis.
Madam Chair, I think this would be a question that either the budget director or the commissioner would best answer, because you're talking about what happens when the federal money comes into Minnesota and what does that do to the budget?
Commissioner Showalter.
Thank you, Madam Chair. Senator, the quick answer is you're right. Federal money almost always has some kind of proof, strings attached to it. These federal dollars I know our cognizant agencies are working through with their partners to understand exactly what kind of match is necessary, what kind of restrictions are tied to each of those dollars. That's particularly important with some of the transportation dollars. But you know, I think as we get closer to putting out the capital budget and starting to think about those projects, I am sure we're going to get into some deep dives and understanding what those instructions from the federal government are.
Thank you, Madam Chair.
Thank you, Senator Murray. How soon do you expect those guidelines? They would have to come out fairly soon. What say, Commissioner?
Madam Chair, I haven't seen anything. I don't know if the state budget director is closer to the ground on what we have in hand at the moment.
Madam Chair, members, we don't have guidance for most of the federal funds. Some of them are using existing programs, so we can maybe make assumptions, but we have been participating through various channels and providing questions and feedback of what should be reflected in that guidance. But we don't have them yet, and we're not exactly sure when we will. So it's something that we're monitoring closely because we are also eager to understand.
Well, the IIAG, the 4.8 billion for transportation, broadband, all the infrastructure, that's a 20% match. We're going to need to have guidelines on that fairly soon if we're going to, start incorporating that into a supplemental budget in order to. I do have a question on the forecast change for 22 and 23 on the corporate franchise tax. It's a 40.6% increase. Is there any way to recognize or look at tax receipts from small to large businesses and who is contributing to that amount? And that seems really high when you put a pencil to it. 40.6% increase for corporate. Is there any way to determine what kind of corporation is contributing?
Madam Chair, members of the committee, so the corporate franchise tax is levied on C corporations. So they are not pass-through corporations. So the pass-through entities, partnerships, S corporations, sole proprietorships, they're taxed under the individual income tax. And so to the extent that you think of small businesses as being those pass-throughs, then those are not under the corporate income tax, but there is a range of sizes within C Corps. I have no way of telling what size the companies are that are paying that. Let me see if we don't construct the corporate franchise tax based on differentially for different sizes of the companies. But I can say that the bulk of the money coming in on the corporate franchise tax is from large multinational corporations. Just makes sense, that's where the money is. And it is a large forecast change. And we saw, as I mentioned in my comments, we saw very large corporate receipts early this year and continuing through into this fiscal year. So we ended fiscal year 21 with a very large variance in corporate receipts. So they paid much more than we had anticipated. And they've continued to pay more than we had anticipated, which is the part of the reason for the higher forecast. That story is consistent with what's happened at the federal level as well. Both and at state and with states. So both the Congressional Budget Office and NASBO with regard to the states have reported large growth in corporate receipts in fiscal year 21 and a large growth in corporate profits. And the CBO has also increased their forecast for corporate taxes. So to answer your question, it's consistent with what we were seeing in other forecasting units. And it's levied on C corporations, not pass-through entities.
Thank you. Looking for some other hands. If not, I have one more question about the FMAP. We received, oh, good, Senator Marty's coming, but on the FMAP, is that, you can't really forecast that. They let you know quarterly, right, on that, State Director Ming, is that correct? And so that's really hard to not forecast that in the future. That's just something they let you know how to do.
Yeah, Madam Chair, I think our forecast for the enhanced FMAP, we base it on what we know about the public health emergency as it's declared by the Secretary of HHS at the federal level. So they did extend it into the first quarter of next year. So we're assuming we get it through the first quarter of next year, but we aren't assuming that it goes on beyond the first quarter of next year.
And that was put into the forecast.
That's right. That was put into the forecast. So it generates $238 million of savings in the 22-23 biennium. However, as you may recall, the longer the federal public health emergency extends, then we are required to meet some continuous coverage requirements. And so we have some offsetting costs associated with higher enrollment. So on net in 22-23, medical assistance spending is relatively unchanged.
Okay. Has that been unchanged throughout the pandemic? Or has it been variable?
Madam Chair, generally the savings from the FMAP more than offset the cost of the continuous coverage provisions. And there are other changes within medical assistance that are contributing to the overall lack of change, I guess. So, but the impact of the FMAP alone is $238 million in lower spending.
Mm-hmm. Thank you. Senator Marty.
Thank you, Madam Chair. A comment, I guess, about what Commissioner Showalter said about inflation, and that is, I do hope I have a bill I would love to have heard, Senate File 2362, which would instead of excluding inflation from the budget forecast, count it on both sides. And I do think that is worth talking about, because just seeing how people talked about, let's use the illustration of education spending. I think a lot of people are saying, oh, this is a banner year for education funding. I think the numbers I recall back at the end of session were that the new appropriations for the current biennium were about 15 million over inflation, and some were saying it was record amounts and so on. But it was, I believe, only like 15 million over inflation. And under the new inflation numbers, it may actually be going backwards from 2 years ago. I don't know. I don't have a good way to factor that in, but I do think that we should be looking to make sure that we're getting the most accurate numbers, which means factoring that in on both sides of the equation. So just a comment that I appreciate the commissioner mentioning that, and I think it's something we ought to be doing just for truth in budgeting, because the agencies and everything like the schools, that inflation is very real to them, whether they like it or not, and we ought to be factoring it in when we make our decisions. So anyway, I hope we can get a hearing on that this year.
Thank you, Senator Marty. Senator Pratt.
Thank you, Madam Chair. Dr. Kolomakidis, just maybe a couple of questions to follow up on what Senator Kiffmeyer was asking a little bit. So you showed that the unemployment rate was down pretty close to where we were pre-pandemic, but we're still about, what, 2.5, 3 points low on the labor participation rate. And your full document assumes that we're going to see that labor participation rate come back. But what I hear demographically is that 18 to 64 population is falling. We've seen increased retirements. Do you still see that labor force participation rate coming back? And how will that impact your forecast if it doesn't bounce back to where it was pre-pandemic?
Dr. Kolomakidis.
Yes, Madam Chair, Senator, members of the committee. The U.S. outlook assumes that over the next couple of years, the US labor force participation rate increases, but they retain the forecast of structural or secular decline in labor force participation due to aging of the population. So they're not expecting it to come back and then just keep growing, because the demographics suggest that that won't happen. And we have assumptions that are similar regarding Minnesota's recovery of the labor force participation rate, that we do not expect it to keep growing as the population ages. So that assumption that the secular decline in the labor force participation rate that we saw before the pandemic, that the assumption that that continues is embedded in the forecast. But I will say that in the meantime, in trying to increase the labor force participation rate while we're still dealing with issues regarding the pandemic, that does create some risk in the forecast, because the pandemic itself, the shift to telework, the lack of childcare, all of those things disrupted household decision-making regarding supply of labor and who's going to work and how much. And moreover, we saw, and I think we talked about this more in the last forecast, but we've seen a very strong appetite for business formation through the pandemic. And so a number of people who have left the labor force may have left the labor force to start a business, and they're not coming back into the labor force. They're going to run their business. So that the assumption that we're going to get some of these people who are on the bench now back into the labor force is important to our forecast and does create some risk. But we haven't forgotten the fact that the population is aging, and we shouldn't expect the 70-year-olds and 80-year-olds to come back into the labor force.
Senator Pratt, you're on mute.
People like me better that way. So Dr. Kalbakidis, you're saying we're still on page 11 of the presentation, we're still 121,000 or 4.4 fewer jobs than we were. Do you have a forecast of what that looks like out in future years, like you do some of the other metrics?
Dr. Kalambakidis.
Madam Chair, Senator, members of the committee, yes, we do forecast employment and in Minnesota. And I think both the US outlook and Minnesota's outlook assume that we are going to recover back to pre-pandemic employment sometime, I can't remember exactly, next year maybe. So there is a forecast for employment growth in our forecast document. And again, I can get back to you on the specifics on that.
Senator Pratt, good. Okay, super. Dr. Yes.
Madam Chair, do you mind? There's something I just found a piece of information I thought might be useful in response to Senator Johnson's questions from a while back about federal payments supporting personal income, and your comments about the savings rate having spiked. And I just want to refer everybody, if they're interested in more information on that, to page 22 of our forecast book. We have a chart showing, depicting a US disposable personal income and the savings rate. And it shows the spikes that occurred when stimulus payments were made. And it shows the forecast. And it just illustrates for Senator Johnson's benefit that we're not forecasting off of those peaks and assuming that we just jump off those high points, that it comes back down to a more reasonable level. So I would just encourage you to take a look at that if you're interested.
Thank you. Senator Johnson, good?
Good, thank you.
Thank you. I was just informed, we're not sure if that was sent to all the members from MMB. If you could please resend that 100-page book to us all.
Oh,
Commissioner. Thank you. Is there any other further questions? Well, thank you again, Commissioner Showalter and Dr. Kalambakidis and State Budget Director Ming, for your time this afternoon. This is very informative. I know we are going to hit the ground running probably the 1st of January, even though we start at the end of January, but we have a lot of work to do. And I really look forward to working with all of you. And with that, have a wonderful holiday season. Be safe, be healthy, and enjoy your family. Any further comments? Okay, thank you so much. Merry
Take
Christmas.
care.
Okay, bye-bye now.
Thank you.
Thank you. Bye-bye.